Markets are flipping bearish. That's it. I'm saying it. We're going out here and we're going to change our tone as the buyers have failed to hold on to a key level of structural support. But it's really, really important that we do this responsibly, do this tactically, because being short in the hole, as they say, shorting the lower low basically, is the last thing we want from a trade location perspective. So let's build a game plan based on logic for the remainder of this week with an updated outlook for our marketplace. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's kick things off here on the SPY daily time frame chart. What do we see from a trend perspective? I would argue that the daily trend is neutralizing. It's not all the way in a downtrend yet. My reasoning for that would be that we are pulling back from a higher high in this overall trend sequence. So if this is a higher high, we don't actually have a daily lower high yet. These are just hourly lower highs. We never flipped into an hourly uptrend to set some sort of daily lower high. So we're still looking for that. That's one of the reasons why you don't want to be short in the hole on the lower low of this overall move down. Of course, the other thing to point out is that this was a set of soft lows. We've been talking about this concept for a couple of weeks now, meaning that the last major set of daily higher lows is technically back here. Now, I'm not going to try to sit here and argue that this is going to produce a technically nuanced higher low on the daily time frame. That's not what I'm trying to do, but it's much more so equal lows. The hourly trend is clearly down once again. This is not an excuse to go out there and make a bullish claim, but I would just argue that the daily trend is neutral for those 2 reasons, and we're looking for a daily lower high to really cement this downtrend in place, right? So that's first and foremost. Secondly, obviously on the daily time frame chart, there were multiple attempts to hold up here. The buyers had multiple opportunities to try to make something happen in the upward direction. Notably, Monday was the most important, and then the subsequent failure on Tuesday makes things, fall apart here. Obviously, there's no gap fill reversal. There's no hold of the prior structure. We do not hold the daily 50 SMA. If you were to come in here with a Fibonacci, which was part of our analysis in the prior videos, right, the 61.8 was right there. We have failed to hold on to that. And you could even remember that we do have a trend channel. This light gray is coming from, if I just scrunch this up, you'll remember anchor, touch 1, touch 2. It was right there, confluence with the daily 50 SMA. We've closed extremely weak underneath all of these levels on today's session. So once again, this is not a bullish call. This is not saying like, hey, the market's slipping into a downtrend, but we're still bullish. No, it's just you do not want to be short in the hole at terrible trade location. You also have the lower edge of this week's expected move. So structure has broken down here. Now it's our job to look for a responsible short entry in the downward direction if this is going to materialize into something more substantial, right? We'll also see evidence for this in the internals for the market as we go through today's analysis. I also like on today's session specifically that we did get a little bit of a counter trend rally here early on in the day's session, and we've rejected the daily 50 SMA on the back test, and we could see that even more so on the hourly chart. So let's go there now. And taking a look at this, once again, I think it's worth walking through the situations as we moved into the early stages of this week. This was the balance range we've talked about, look below and fail. We did get that move on Monday. So this sets up the context for the remainder of this week and the massive disappointment from the buyers, right? Into the afternoon, we get this bullish consolidation and even break towards the upper bound of the range back here. So in a picture perfect world, look below and fail materializes to the top of the range. If that did happen, the ideal pullback would have been a higher low above the balance range. Obviously, Tuesday, opening on that move lower underneath this consolidation puts the burden of proof on the buyers. And now that we're back to where we've started and we have this sort of 100% retracement phenomenon going on, it's up to the bulls to prove it for today's session. I want to be very clear about that. Yesterday, going into the session, we were definitely more bullish than bearish, and I think rightfully so based on the look below and fail. But this morning, I think we're going to be decisively a little bit more neutral to maybe even having a slightly bearish edge here. Break down and produce a lower high intraday underneath the bottom of that range after failing this move higher from Monday. That was really the key to me that, hey, this market is changing, right? It is no longer trying to find support here at this key inflection point we've been talking about. This is evidence that, okay, sellers are stepping up. And once again, the market internals confirm this as well. If you look at today's session, lower high continues to reject that daily 50 SMA we just saw, and we close extremely weak. So what's the game plan going forward? Well, if we look at the anchored view apps and throw these on, you'll notice that we have massive confluence at this level on a back test. If we rally for a counter trend move, remember that this is a counter trend move. We are no longer looking for a daily high or low. We're no longer looking for an excuse to go long this market. We are looking for a counter trend move that in a picture perfect world rejects underneath 443. We already saw it once into the afternoon session today. If we go further than that, you get confluence with your anchored VWAP and then your rejection from the bottom end of the range one more time at 444.90. These two areas are key levels to be thinking about shorts as we move forward. Another thing to be thinking about here is that we do have a descending channel and we've broken through the lower bound, the support portion of the trend channel. Once again, these are not ideal new money short locations. You want to be shorting in the channel for a continuation move lower through the equal low. You want to be shorting at the upper bound of the trend channel. We'll talk about that in just a second here, but the ideal locations that we could just see are here and here into the remainder of this week. Relief rally, looking for a short. Relief rally, looking for a short. Those are the two key levels, 443 and 444.90, that I would be thinking about into the remainder of this week. If we do just get straight up continuation, you're going to have to sit back, relax, and say, I'm not going to get FOMO. I'm not going to chase at the lower low, at the lower bound of the expected move outside of the trend channel, because the risk, of course, is that you do get this nasty snapback for a counter trend move. Shorts are piling in, piling in, piling in. If they get squeezed out, it's not that it changes the fact that we've lost key structure. You just don't want to fall victim to being at terrible trade location with a new position, right? So it's better to have risk reward here, stops above, shorts here, looking for equal lows, and then follow through 436.75. So once again, even if we do just continue in the downward direction, I would be thinking about, can we see a counter trend move off of this? But the context, once again, is this is not a daily high or low pullback that we're looking to buy. This is a counter trend rally that's setting up. You might trade this in the long direction, but just understand that once again, we're not overstaying our welcome on the long side here now that key structure has broken down. All right, the best thing that the buyers could see going forward, and this is very optimistic, I'm not forecasting this based on any of the evidence that we'll walk through going forward, would be some sort of major inverted head and shoulders that looks like this. But even at that, where does the inverted head and shoulders trigger? It has to be on a move up and over 448.75, right? And you can see also you're slowly going to get confluence of resistance there with your anchored VWAP from this is the Bank of Japan news back here, right? So it's also the top of the overall move that we saw. So if this is going to be more constructive on the bull side, this is what we need to see. And obviously with today's close, extremely weak down here and some more weak evidence that we're about to walk through, that's a bit of a stretch into the end of this week. That is a much more so a back pocket situation. That is not a primary thesis into the remainder of this week. Just to sum it up one more time, primary thesis is rejection here. Primary thesis is rejection here. If we do get continuation, looking for a counter trend move only off of 436.75. Let's take a look at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, I'm leaving this zoomed out so you can see the context in relationship to last week's moves. Obviously, volume flows last week, incredibly mild as we were just bobbing around the key level that we were trying to defend. This week, big outflows, big outflows. In terms of the cumulative flows of the week, we're already underneath negative 500 million, which is classically what we look for by the end of the week. In terms of the advanced decline line, last week tangled around zero, coming from trend higher zone to zero, tangled around zero. Monday is bearish, Tuesday is in trend lower zone, and on today's session, we end up moving towards trend lower zone into the end of the day. The cumulative ticks are perhaps the most obvious. Look at these massive builds in the downward direction. It's very clear that there's been a change in tone and stronger sellers are getting active across the exchange level, not just in the S&P and a select couple of names. This is exchange level participation in the downward direction. You should follow us on Twitter because we made note of this change in tone on Tuesday early on in the day's session. Follow us on Twitter at Trade Brigade Co. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Profile makes complete sense here. If you look at what took place on the Monday session, value and point of control were actually higher as compared to Friday of last week. So we could imagine that new money longs were participating here on the look below and fail. The fact that Tuesday we open underneath the value area, underneath the point of control, you can see that there is absolutely zero price acceptance here inside or even close to the value area, and value on Tuesday builds out lower towards towards the central part of the profile, and we do have an afternoon breakdown, of course, that puts shorts in the money and longs from back here off sides. On today's session, I find it very interesting that value is technically higher in the overall profile, but it is overlapping to down as compared to Tuesday's session. We have an incredibly poor high, so this would lead me to believe that, again, being short at these lows is not ideal location. It's likely that we could see repair of the poor high, set some sort of lower high, and then make the rotation in the downward direction when new money shorts can get active at a place where volume is willing to transact. As of right now, being short at this low doesn't really make all that much sense. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that the XLK heaviest weight risk on tech sector actually leads the pack here. Now, don't get me wrong, everything is red, so it's leading by being down the least, but it's only off by about 1/4 percentage point. At the bottom of the barrel, we see the XLE for the energy sector down a whopping 3.07%. But more importantly, I want to point out that this does not appear to be a risk-off rotation currently, with real estate, consumer staples, and utilities at the bottom of the barrel. If this was a risk-off rotation, we would be selling off tech aggressively. Tech would be at the bottom of the barrel, and the lighter weight risk-off sectors would be not being, beat up so bad. There would be some sort of rotation trying to move into that for some sort of yield. So this is a full-blown correlated look in the downward direction, which was the major threat we discussed in the Saturday update video. So what does all of this mean? Why do I bring this up? Because the next key question to be thinking about, the next sequence to be paying attention to, is when and if the SPY gets a counter trend move, what sectors are leading that counter trend move? Now, please don't misunderstand what I'm saying. Nothing about the daily bar structure here would suggest we're ready for a counter trend just yet. This is just not ideal location for a new money short. But when and if the counter trend takes place, is it being led by the heavyweight risk on sectors, or is it being led by the lighter weight risk off sectors? If we set some sort of daily lower high that was led by the lighter weight risk off sectors, we can have much more confidence shorting that daily lower high. Whereas if we're being led by the heavier weight risk on sectors, we might think twice about how aggressive we are. Maybe that reflects in your position sizing on the daily lower high attempt, right? So that's the next major sequence to be thinking about. However, let's keep it realistic into the end of this week and take a look at our structural charts. In terms of the XLK, you're definitely getting a bear flag consolidation look down here. You could call it a very classic H pattern. This is not like the S&P. It did not produce a lower low. As a matter of fact, it produced an equal low. So if we get the equal low breakdown, which is a reasonable place to look for a breakdown, right? We could see rotation into 163.25, thus putting downward pressure on the S&P into the end of this week. So once again, there is no look here currently that would suggest a counter trend rally is around the corner. This actually looks more bearish than bullish, obviously. The only bullish look would be if the XLK could take out with a confirmed higher low, the top of the flag range, putting sellers offsides in the flag range. That level would be 170. Nothing about today's daily bar would suggest that as a higher probability outcome. Let's take a look at the XLV, what's going on with the healthcare sector, second heaviest weight by market cap, D for defensive as well. There's an opportunity here still for a daily higher low. So although, we're sort of getting a heavier weight risk on sector leading, the XLV from a structural perspective actually looks better in terms of trying to keep this minor uptrend intact here. Now, once again, nothing about the daily bar would suggest that we're ready to rotate back up into the range. However, if we do pull back and find some sort of higher low, anything that's above 132.65 keeps the XLV on sides, and ultimately over time, you're probably going to look for some sort of ascending triangle. If you're trying to look for the double top, just remember it's not a double top until it is. You have to break on down through the neckline, which right now is Confluence super support, daily 200 SMA, daily 50 SMA at 132.65. Next up, we see the XLC, what's going on with communications. It's coming into the daily 50 SMA. Once again, nothing bullish about the daily bar. As a matter of fact, it's bearish. We've broken on down from the range. The range double brings us closer to our next daily structure at 65.55. This would be bearish pressure into the end of this week. The only bullish thing to look for would be like an hourly higher low for a neutralized type look for the S&P over 66.75. But the current look on the daily, a little bit more bearish than bullish. XLY, what do we see over here? Loss of a major level on the XLY. Obviously, Tesla getting beat up is no help for this one here. Breaking on down underneath 167.25. Bearish consolidation underneath keeps the S&P with downward pressure. If we get a move back above, I still wouldn't call it bullish in there. That's neutral at best. The only bullish look is a higher low, confirmed higher low, over 170.25, the bottom of this original range that we've broken on down from. Next up, XLI. What's going on with industrials? Inverted hammer, gap fill reversal, the whole 9 yards, closing weak at the lows, but at a key level. I would give this one the benefit of the doubt and say, okay, we've already range doubled in the downward direction. We're kind of home at that target, looking for some sort of excuse for a counter trend move, set the next lower high, and then we can look for trend continuation in the downward direction. 106.50 is the support, and the resistance you want to see hold is 108.15. Next up, we've got the XLB for materials, lighter weight sector. However, undeniable downward pressure is downward pressure for the market. No hold at the key level here at 82. Once again, hard to be bullish when everything is sort of deteriorating in a more substantial fashion across the sectors. XLF, this is also deteriorating from a substantial sort of factor as well. If you think about this as daily bull flag, no attempt to break out of the flag. Obviously, the Fitch threat of a secondary downgrade coming around the corner produces a big gap down on Tuesday. Today, we get a failure from the buyers to get any price acceptance in that Tuesday range, and we're just sitting on the daily 50 and 200 SMAs over here. So there's still an opportunity for something like a weekly higher low off of key structure. This level is very important to watch at 33.65, but to get there, and obviously with the inverted hammer into the end of this week, it's likely going to be bearish pressure. The only bullish look for the XLF would be a higher low over 34.65. It seems like a stretch given the daily structure that's unfolded here. Next up, utilities. This is where the full-blown threat of downside correlation really shines through, right? We already talked about 100% retracement, lower high under 65, and you break on down, there's no escape basically from the sell side pressure out there in the market. And this once again speaks to the correlation to the downside, not necessarily the risk off rotation. You are getting an inside bar. It is underneath the bottom of the flag range. That would strike me as a bearish indication. If it does continue lower, obviously downward pressure for the markets. The only bullish look out of utilities, if the rotation does start to come into play and we see that risk off rotation, you would want utilities up and over the last lower high at 65. So still some work to be done from that perspective as well. Next up, consumer staples, same concept, right? This is a D for defensive sector. Why is it not holding up here? It's because we're seeing full-blown correlation, not a defensive posturing rotation, basically. So 100% retracement, hard to be a new money short down here. You would be looking for any lower highs, ideally underneath your moving averages at this point in time. You want to see a back test of roughly 74.30s, and if you can reject off of that on a lower high, it sets up the H pattern, equal low flush. You could call it sort of a head and shoulders. It's not happening at the top of a range, obviously. However, your equal low breakdown would be that 73.25. So this is setting up for a bearish pattern in my eyes, not really looking like accumulation currently. This was the opportunity, right? Sweep the lows, come back up. That would have been the bullish rotation. Obviously did not take place with the move lower on Tuesday and today's session Wednesday. Let's take a look at real estate. Not much to write home about over here. This one should be fairly obvious with rates moving higher, up and over 4% in the 10-year, 4.2% even. No surprise that real estate is lower, lightweight sector, but nonetheless downward pressure is downward pressure. Energy, last but certainly not least, once again, this similarly so to the XLV from a structural perspective, although it's getting beat up the worst on the week, structurally, there's an opportunity here for the uptrend to remain intact, right? If this is going to be look above and fail, that's fine. Rotate to the 200 SMA, then you set up the head and shoulders over time. It's not revealing itself yet. If we get some sort of thing that, holds here over 87.30 into the end of this week, that starts to feel like there's the possibility for the risk off rotation as and if the counter trend move happens in the SPY. So hopefully you can see based on the levels analysis, there's clearly the opportunity for more downside into the end of this week, but the next structural, I shouldn't say structural, but the next conceptual thing to be thinking about is who leads the counter trend move in the S&P. Here's the sector ratio grid. If you're not familiar with how to set this one up, check out the video tutorial in the top right-hand corner. Once again, as we've been saying the past couple of weeks, the risk on look is fading here. I would actually say that the risk on look is sort of off at this point, with the XLK giving an opportunity for a lower high here underneath a now descending 50 SMA. The XLV from a defensive perspective has reclaimed the 50 SMA. Now that's flattening here. So this is a risk off beginning style look. The reason I wouldn't call it full-blown risk off yet is because utilities still in the bottom left-hand corner here are really lagging this move. But if we look at other risk on sectors, remember that the XLF was giving this opportunity for stair steps in the upward direction. This is a range produced an equal high, equal low. Whatever way it moves out of this box will be fairly telling for the next rotation in the market. And once again, this speaks to who leads the counter trend move out of the S&P. If the XLF wants to do this, make a higher high, that would be a little bit more confident of a look, as opposed to if it makes a lower low and the XLU breaches the 50 SMA, now we're all in on trying to find and short the daily lower high, right? The other honorable mentions here would be the XLY breaking on down through the 50 SMA off of some sort of daily lower high, and energy, of course, screaming to the upside. As we saw from the structural chart, the uptrend there is very much so intact. If we take a look at some more nuanced ratios, so the XLK versus the XLU, this is telling us to be cautious about the rotation for the next counter trend move, right? If the next counter trend move is kicked off by tech and tech leads the way, this will remain in an uptrend, and that would really be more so of a risk on indication as opposed to a risk off indication. If it does break down during the counter trend rally, that would be your big tell once again to say, hey, we're looking for the big daily lower high, and we're going to short that thing with both hands when and if the setup unfolds. Next up, XLY, same concept, right? If this is going to turn into a daily head and shoulders here on the ratio, you got to break down through the neckline. As of right now, we're waiting with bated breath. We're holding our breath saying, okay, let's look for the counter trend, and then what's going to be the fate of these ratios. As of right now, I would argue that this obviously is threatening up the breakdown of the head and shoulders, which would be a bearish indication, more of a risk-off rotation, but we don't have the confirmation yet. We'd rather be late with confirmation than early and wrong. The dollar has certainly come back up into the range, and more importantly, it's gone for the full equal high on the daily time frame chart. 103.50 has been hit, and we closed strong up there towards the top of today's trading range, which in effect is putting downward pressure on equities over here. Now that we have the equal high, the most important thing to be discussing is a higher low pullback could technically go now all the way down to 101. It was a different story when we didn't have the equal high on the table. If we were to have pulled back to 101 from here, different look, right? Because now you're still dealing with some sort of a downtrend, right? And there's the opportunity to go back to the equal low. With the equal high on the table, now a pullback to 101 still has the opportunity to do this. And next thing you know, you've got yourself inverted head and shoulders. There's nothing, once again, that would suggest we are likely for a pullback yet. But just speaking from a trend perspective here, the dollar looks like it can continue to be a threat for equities down below. And if we have a look at something like the gold contract to see if it's confirming this sort of outlook, I would argue 100% yes. I mean, it continues to drift lower, making a new lower low, regardless of the contract rolls or not. The downtrend here is quite severe, and on a lower low, it would totally support the thesis that the dollar can be moving higher under these circumstances. So that relationship overall, as we know, is bearish for equities down below. There needs to be substantial and material improvements out of this and the dollar moving in the downward direction if that were going to reverse. Let's take a look at the TNX. 10-year interest rates have been at the highest highs of 2023, right? There was a little bit of a higher high back here at the end of 2022, but these are the highest rates we've seen all year. And I'm honestly really surprised that the tech sector is not getting absolutely hammered based on this information over here. So to my surprise, it might in theory say, okay, when and if we get the counter trend move, if it's being led by the tech sector, if rates are backing off a little bit in that sort of, series of events, that might be, once again, a little bit more confidence inspiring for not being overly aggressive on the downside and managing size at that first daily lower high. It's something to be thinking about. The TNX is moving higher now because, in my eyes, the inverted ZT, which is basically what the Fed funds rate tracks, is also making an ascending triangle back up at the equal highs now in testing in short proximity of time. We know from a technical perspective, that would mean that the odds of a breakout here have increased, especially with an uptrend, preceding us here. That would be an indication that, yes, it is likely that the Fed is going to raise one more time into the end of this year. So we're watching this level like a hawk. If we get an equal high breakout, I would imagine that that spells downward pressure for the market as we move forward here. Let's take a look at the tracker tool, though, and see what that has to say. Still pricing in higher odds of a pause for the next meeting, which, as we know, is out to September at this point in time. But there was a very minor downtick on today's session as we got the retail sales along with Empire State Manufacturing. This gets magnified if we go out in time to something like the November forecasts. You can see lower odds of a pause here, higher odds of an increase for rates, another 25 basis points. And if we go out to December, it's the same concept where higher odds, or it's not overwhelming odds currently, but you can see the increase in probability of a rate hike and the decrease in probability for a pause into our next couple of strings of meetings here. If we go out to the probabilities tab, you can see that we're still higher for longer, pricing out into even later at this point, 2024. You can see that this pause on the second, after the first cut, the secondary pause is going out to June of next year. What I think is really the most interesting part about this is that the lack of Fed meetings and communications ahead of the September meeting, which is kind of ironic because we're getting Jackson Hole next week. We'll talk about that in a second. But the lack of communication means that the market is doing the job of pricing in expectations for the longer time frame, right? The pause or lack of meeting, I should say, in the August month. So because of that, you're getting this wild volatility out of rates and expectations for the Fed. It would be really helpful if during the Jackson Hole summit next week, we get some insights from the Fed. In terms of data that was released today, retail sales came out 1.0 versus 0.4 expected on the core and 0.7 versus 0.4 on the normal. Empire State Manufacturing took a whopping hit there, down 19 from a 0.9 negative expectation. So you're getting a lack of manufacturing sort of improvements from a conditions perspective, but the consumer still appears to be spending solidly. We know that credit card debt just hit $1 trillion. Everybody's freaking about $1 trillion credit card debt. We know that debt payments are a low portion of household obligations right now. It's not to say that it can't blow up in the future. However, this to me would be an indication that, hey, if the Fed is going to rein in on inflation and really dial back the spending that the public's doing, we're going to tighten the belt even more. One more rate hike could be around the corner. And to me, that's why, again, the tracker tool moved higher slightly in the further out meetings, but more importantly, the ZT inverted today made that move for the equal high. If we take a look out at next week, a lot of things taking place that we're going to start paying attention to. The BRICS summit is kicking off. Not really convinced that that's going to be a material impact on the dollar. Nobody really wants to be buying currencies that are massively devalued against the dollar. We shall see. But manufacturing PMIs and services PMIs will be coming out. Unemployment claims as always. And then the Jackson Hole Symposium kicks off on Thursday, right? That is where Jerome Powell historically has made some pretty severe comments about the market. We all know what happened last year. And, we'll see if that's going to be a merry-go-round and a rinse and repeat for this upcoming year. So really keeping our wits about us on the end of next week, Thursday of next week. Will we learn more about the expectations of what to expect going forward? Probably. Probably will have some comments there. If the Fed is going to be data dependent, we know that with retail sales, which came out the way that they did, if unemployment claims continue to come out okay, not really the end of the world. Obviously, we get some more of those on tomorrow morning session. It's very likely that the Fed could raise rates one more time, given that the data has not deteriorated materially over in the labor market specifically, right? These are still strong numbers in terms of retail sales, unemployment claims. The initial is, it moved higher, but continuing is moving lower. If they start discussing things like that, hey, the economy seems resilient still, we can still continue to maybe, be data dependent. If that's what they say, I would imagine there's one more in the pipeline or just substantially higher for substantially longer into 2024, which the market would not be liking from a tech perspective. How about the risk appetite charts? The TLT ratioed to the S&P is still sitting sideways on these lows and underneath our resistance trend line. So this does not yet look like a full-blown flight to safety style trade. And the only uptick that we saw in the previous week or so's worth of trade was a counter trend move, which is totally normal and to be expected in the face of an aggressive move in the downward direction. So this would speak to decent risk appetite for equities down below. But we've been talking about how this may be broken as we move forward into a new paradigm shift with higher interest rates for longer. So what we can do instead is look at bonds in different durations, and the fact that these remain elevated here, the shorter end of the curve is being favored as opposed to the longer end of the curve would speak to uncertainty and volatility in the market. And definitely, under those circumstances, what does that tell you about investor sentiment? People are sort of nervous, right? So the fact that these remain elevated and we did not see pullbacks off of the equal highs, these are breaking out into the future. To me, that is somewhat of a risk-off indication, right? We could also look at the LQD. This is a relationship that we've been monitoring the past couple of days, past couple of videos. We were pretty enticed by the rollover look up against the descending 50 SMA, but obviously it's starting to look much more so like a head fake with the volatility in interest rates themselves. So if this continues to break in the upward direction, that once again speaks to more risk-off sentiment in the market. So ideally, this rolls over. If you notice that it's continuing to spend more time over the downward sloping 50 SMA, that is a risk-off indication for markets. Once again, we're going to pair that with whatever happens with the sectors during some sort of counter trend relief rally. Let's take a look at the HYG, because although it's coming into sync slightly, it's still divergent, right? So we are moving lower here into the more recent price action. However, if we look back, this low, we technically have the opportunity for a higher low, whereas in the S&P equities, we are already sitting on a lower low. So whether or not this comes back into sync is yet to be seen, but it's one thing that is divergent and not totally confluence with the aggressive move in the downward direction. We're keeping tabs on it. This this one data point alone is not enough to be overly bullish on our market. And if we take a look at Bitcoin, what's going on with the digital gold? Absolutely nothing. It continues to be sideways, moving along. How about the market breadth? Certainly looking at a negative, new highs versus lows underneath the zero line. No good out of this chart. Remember that we can afford to play around near the zero line, but we cannot afford to really produce much more so of a negative impression from this indication. So as we're pulling back and this is going negative, not really a confidence inspiring look. One of these data points, or this is one of the data points I should say, that's inspiring us to be more so changing our tone as we walk forward from this pullback, or maybe the start of something more than just a pullback, right? If we look at the SPX A200R, this is still a weekly time frame chart. We're back down at the 50% mark. Ideally, we wanted to find some sort of higher low above that. There's still the opportunity to stay above 50%. However, on a pullback here in relationship to our prior lows, we really don't want to flip underneath 50%. We would have ideally wanted to have a higher low somewhere north of 60%. Not the case, obviously, as we round out the end of this week. Let's take a look at the SPX A50R. This one's really damaging. One of the comments that I made in the Saturday video was that if this was going to remain a healthy higher low pullback, you can go back and watch the video, we wanted to see the SPX A50R bottom above the 50% mark. Obviously, aggressive breakdown on the Tuesday and today's Wednesday session that puts that as a bearish data point walking forward, really reaffirming the change in tone that we're experiencing in today's episode. Once again, we don't want to be short on the lows, but we are seeing meaningful deterioration across many indications we watch for our broad market. Another thing we were talking about was the opportunity for the RSP to still find a higher low over 150. We've broken on down through 150. That would once again reaffirm and align with the change in tone that we're experiencing into the end of this week and really just walking forward. I don't want to zoom in on the Dow. However, you can see that they're both pulling back. No major divergences. One's not remaining elevated, which would keep us a little bit more bullish, right? That would be a bullish divergence. Nope. Both are pointing in the downward direction. Both are agreeing with the larger breakdown we've experienced thus far. VIX volatility. We warned about the deceiving close underneath the 15 mark in the Saturday update. And the reason that this was deceiving, notice that obviously we're back elevated in this as an overall range. The reason it was deceiving was because the VVIX, the volatility of the volatility index, although it did pull back on the Friday session, it did not make a lower low or close anywhere near the lows of the balance range. And now you can see the VVIX is certainly over the key inflection point at 103. So are we in store for a little bit more of a volatility storm? This would certainly suggest that, yeah, you should buckle up. It's not necessarily over yet in the S&P 500 in terms of downside. Let's take a look at the VIX futures and see what's going on with vol futures. Moving towards an inversion. We're not there yet. Obviously, the zero line is way up overhead. However, it's been an aggressive move in the upward direction, undoing some of the contango, working towards somewhat of a mild backwardation. Once again, you have to be over the zero line for that to be in effect, but the directional vector here is what's important, right? VIX 9-day versus 30-day, it's up against the zero line. It's not inverted. We're not in backwardation. However, again, it's the directional vector that really counts. In terms of the one-day VIX, there's an interesting insight here that I think we might want to start paying attention to. It's just tracking the lows, and this would speak to the nature of volatility on a day-over-day basis. Instead of resetting and being sort of back down here as we moved out into the future in these subsequent days, every day that we continue to open up, volatility is here, it's elevated, it's elevated, it's elevated, it's elevated. That to me is one of the possible indications that we might start to take away from our one-day VIX. It's early on in development. However, it's something that I'm thinking about. Therefore, I want you to be thinking about it. If we were to break this trend line and refocus one-day volatility back down here towards the lows, which have seemed somewhat sustainable as of right now, closer to, let's just say like 7.5, that would be a healthier look for volatility getting sucked out of the market. If we continue on this higher low path, it would speak to increasing volatility and the opportunity for some sort of black swan event to really poke us up and over these highs. We haven't really experienced something like that yet, but that's the watch currently with the one-day VIX, and that's what I'll be keeping eyes on. QQQ daily time frame chart is much more bearish, and it's been that way for a while with a daily lower high already in place. We've flushed the equal lows. We have a string of lower lows that have been produced. We're looking for our next daily lower high to really be set. The daily lower high wants to be anywhere underneath 372 on a counter trend move, something that does this, keeps the daily downtrend intact in my eyes. 372 will be key resistance for that reason. However, just like the S&P, nothing about today's daily structure would suggest that we have a counter trend rally, a relief rally rally around the corner here. As a matter of fact, breaking down from this as a balance range through the equal lows, this is like day one of a breakdown. We can look for day two follow through, whereas the S&P is already kind of home at the target, the lower bound of the expected move. The QQQ is not. The target would come from the inverted head and shoulders head of the pattern way back here. Confluence once again with the lower bound of the expected move. 357.50 would be the daily downside target on continuation into the end of this week. Let's take a look at the hourly time frame chart and see what's going on from a smaller time frame perspective. How are we doing from a trend channel perspective? You can clearly make the same arguments for this being the original range to concern ourselves with. There's the look below and fail, never made it to the top, no opportunity for the higher low pullback, so on and so forth. But notice the difference out of the QQQ is that on today's session, we actually set the lower high underneath the bottom of the balance range as opposed to on Tuesday's session, and then we get the equal low flush, right? This is why, in my eyes, the QQQ might actually have more downside to go into the end of this week. I still wouldn't be an advocate for new money shorts on the lower low, but you can much more clearly build the case for a severe lower high underneath the bottom of the breakdown range, and then look for follow through in the downward direction without being, far stretched. Another easy comparison would just be if you do something like this on the QQQ. Notice that we're not through the lower bound of the trend channel, whereas the S&P on a relative basis is trading like somewhere down here, right? So that to me would be a reason to probably favor shorts out of the QQQ on remaining price action underneath 364.50. Once again, lower highs there. Target the level at 361.60, and then the head of the inverted head and shoulders lower edge of the expected move for this week is closer to 357.50. That's the downside. The stronger upside out of this market really only comes on a recapture of 372. We talked about a daily lower high off of that level. You can still get a very clear opportunity for an hourly lower high here. And if I were to just sketch back in the upper bound of the trend channel, right, you can build confluence at 367.65. So even if we're not ideal underneath 364.50, hourly lower high gets set here. Anything above that, you get some sort of counter trend rotation for the daily lower high up against that 372 that we were just discussing, right? Really, for the buyers to have much more control for a stronger reversal, just like in the S&P, this would have to build out as an inverted head and shoulders. You'd have to get price acceptance over that 372. Nothing about today's action, nothing about where we're currently closed would suggest that that is highly probable. If we take out our anchored VWAPs, you can see there is the Bank of Japan, there's the credit downgrade, there's the CPI. This is building confluence for the hourly lower high trend line as well, up against 367.65. That's coming from the CPI. If we do go higher, if we do get that counter trend rotation, you're looking for resistance at that anchored VWAP or confluence over time. If this happens early next week, you could build the case for the anchored VWAP from the Japan news back here at 372. So no matter how you slice the cake right here, it is looking more bearish than bullish, with more so an opportunity for follow through in the downward direction out of the QQQ as compared to our S&P 500. If we take a look at the internals for the Nasdaq side of things, just as bearish, getting some decent reads out of the volume flows, approaching but not breaching the key level, negative 400 million on the Nasdaq side of the market. We are in trend lower zone with a pretty correlated move on the Tuesday session and drifting off of the zero line lower on today's session towards trend lower zone as well. Cumulative ticks speak for themselves. No reason to rehash everything here in the market internals. Here's the Nasdaq market profile. This, interestingly enough, to me, the value area, again, it is overlapping to down. Point of control is lower, but I'm just kind of looking back at this here, and we have more so the value area back inside of the range. And I suppose, if anything, that would just be an indication that if we back test it, you still have more overhead supply that's willing to sell for a break, even perhaps on the retest of the bottom of the 3-day range that we just flushed through, right? Supporting the case for this being day one of the breakdown, looking for day two follow through into the end of this week, perhaps Thursday or Friday. If we get an inside doji on the structural charts and then flush it into the Friday session, that would also make sense, keeping the overhead supply off sides as long as we're underneath that. In the NQ futures, it would be 15,040. IWM Russell 2000 and the small caps, an absolutely brutal close outside of the lower bound of the expected move on today's session and also at the lower portion of today's trading range. Nothing about this daily bar would suggest we have a counter trend rally incoming. However, just like the S&P, I would not be an advocate for a new money short here in small caps. If anything, the fact that this is moving lower so aggressively is just helping build the bear case from a risk on versus risk off perspective for the broad market as a whole. I'd also like to point out on the daily that there was absolutely no attempt for a higher low from the weekly perspective off of key structure at 188.25. As a matter of fact, in today's upper wick, we backtest it and reject there quite firmly, once again closing extremely weak at the lows of today's trading range. So from a risk on versus risk off perspective, this would suggest risk off is right around the corner. If we take a look at the hourly time frame chart, ideally any sort of lower high here is now underneath that weekly level at 188.25. So even if we do go for a counter trend rotation just to get back inside of the expected move, because this level is so structurally significant from the weekly perspective, 188.25 is going to be a beast to get back up and over. If we do get some sort of higher low above, maybe we go for a stronger counter trend rotation, but still looking for a lower high underneath 191.25. If we just quickly throw on the anchored view app specific to the IWM, you can build the case that over time, again, this is not going to happen over one day. So as time passes, this will continue to drift lower, as will this. Doesn't really matter when we meet it, but if there is a stronger counter trend rally, you are going to have to deal with both anchored view apps to the move from back here. Basically at the top of the move, this is the Fitch downgrade, of course, and this is your CPI. So 191.25 key lower high can be set there on a counter trend rotation. Not an advocate for new money shorts down here. Ideally, shorts are off of a lower high below 188.25, or if we go beyond that, you can scalp longs in the upward direction, but I would not overstay your welcome as we approach 191.25. If we take a look at the Russell internals, these are also bearish. I would argue that Tuesday was not nearly as bad. You can see that the Russell internals here, they didn't get close to that negative 150 read, which is significant for the Russell side, whereas the ES and the NQ definitely got beat up more so on the Tuesday session. In terms of the advanced decliner, it's also spending more time under the zero line this week, drifting lower on today's session, and the cumulative ticks really speak for themselves once again. So everything is in alignment for the downside out of our other broad market ETFs. If we look at the market profile for the Russell side of things, notice extremely poor low gets repaired on today's session, great excess at the highs. We did have a poor high I didn't point out on the Nasdaq futures there, but however, great excess, great excess. Where's the point of control on today's session? Dead on the lows of the session. So, nothing about the IWM is bullish by any stretch of the imagination. Could you argue that the point of control flip to down here is new longs accumulating on the pullback? I mean, you could make the argument in theory, but based on the daily structure and the failure to hold that weekly level we just discussed, it does not strike me as a bullish look by any stretch of the imagination. Once again, not a new money short down here, but this is fairly concerning. Value and the point of control did migrate lower severely with these lower prices. If you've made it to this point in the video, let me know down below in the comments section. My mojo is back. I'm having a great time recording today's episode. I'm feeling good about the market. We're seeing it clearly here. I'm fired up. Hopefully you can get that sense from my voice as well. But Apple kicks off the core list of companies, breaking down from the bear flag on today's session. Daily inverted hammer closing inside of the gap range, looking for some follow through in the downward direction here. Obviously, if Apple goes, the market will go with it. Looking for continuation underneath 175.70. There's quite a void of price action from this thin structure on the rally until 170.40. So quite a ways to fall out of Apple. If we take a look at the hourly structure, you'll also notice, let's zoom way in on the consolidation and the balance range. All of the balance before the end of day breakdown today is underneath the midpoint of this as a range. Notice that this is your next sequence of lower highs. So failed attempt from the buyers, failed attempt from the buyers, lower high back in range, lower highs underneath the midpoint of the range. So bears are building some steam. It's looking like a descending triangle breakdown if you were to sketch it in something that looks like this. Watching for 175.70, but if we can clear that with lower highs continuing underneath, as we pointed out from the daily, there's some downside room to run. That obviously would be bearish pressure for your S&P 500. The only bullish look for Apple into the end of the week is if there's some sort of miraculous recovery up and over 179.75 with a higher low. You've got to prove it so we can start rotating through the thin structure back here. Doesn't seem likely as of today's close. Let's take a look at Netflix. This is still an hourly time frame chart. This is setting up for, I would say, possibly a bounce, just because we've already seen the sort of rotation from the breakdown of range here. We've doubled the range. We're home. We're quote unquote at the target. So again, not an advocate for new money shorts at the lower low of this, at least as a move. I get it. It's an equal low to back here, but you'd probably want to see some sort of counter trend relief rally and then the equal low in shorter proximity of time before looking for the breakdown of 415 to lead you to 397.75 in the downward direction. So what would I do for Netflix into the end of this week? If we sweep it and come back above with a higher low, scalp longs only. Please do not overstay your welcome. Scalp longs only on a higher low over 415 after the proven failure from the sellers to continue under 415 for the rotation back up towards 427.50. You might even get a lower high underneath that, closer to this area at 422. Carry forward 422 as a possible lower high area for something that continues your hourly downtrend. Let's take a look at Tesla. Tesla is continuing to fall off of a cliff. Great gap fill reversal on today's session. Here's the daily time frame chart. We're flipping back to a daily time frame chart. So gap fill reversal, closed the gap, closed extremely weak back down underneath the opening print. So if anything, that should tell you all you need to know. Nobody wants to be long Tesla. There was some, buy side momentum to close the gap, correct the overnight inventory, and then it turns into sell, like Kramer basically, but inverting the buy up against the prior low of day. So closing extremely weak at the lows. Again, nobody wants to be long this. I would not be bottom fishing here out of Tesla. The next major supports that we can think of would be closer to 221 and then your daily level at 214.65 from this minor balance here. But even at that, those are not like incredibly, I guess maybe the 214 pairs nicely with prior structure from back here, but there's still some room to go to the downside before we come into major structure that would really make more sense from a higher time frame perspective, like the weekly or even monthly here. So if monthly and weekly buyers step up to buy this as a pullback, 214.65, indicating some further room to fall into the end of this week. And the inverted hammer, once again, gap fill reversal. Nobody wants to be long here on that initial momentum, just inventory correction, and we drift lower and break lower into the end of the day. Let's take a look at Google. Google, flat on the session, literally 0% over here in the market minder window. Here's the daily time frame chart. The reason that I continue to bring up this Google daily time frame chart is because of this dynamic right here. Nobody who was long from down here is willing to sell yet, right? And nobody who is short down here is thinking, oh, great, I'm feeling comfortable about my position. If anything, the days that continue to pass by, as long as we're above the top of this prior balance, we'll call this balance 1, more shorts start to close out, adding buying pressure to Google over here. So yes, I will concede if we move on down to the hourly. Certainly, we've fallen underneath this balance range here, but I would not look for aggressive shorts in Google until we develop a new downtrend inside of the gap. Not coming from a downtrend, a new downtrend that is confirmed, meaning lower high and lower low inside of the gap before looking for shorts out of Google. If we do, it has to happen underneath 127.65, 126.25 becomes a target, 125, full gap close is 123. Google longs could be content on a look below and fail of this range. We already got it once, so I'm not sure I would trust it the second time around, but if we can confirm some sort of higher low, and if, this is the key component, right? If the broad market as a whole is also moving higher, you might try to take a stab at Google long on a higher low over 129.10 for that look below and fail one more time. Let's take a look at Metaverse. What's going on with Zuckerberg's Fantasyland? Breaking down and closing underneath our daily 50 SMA. This is important. Let's go actually back out to the daily time frame chart. If there was going to be a more picture perfect, reversal for a daily higher low out of Meta, you were probably hoping for something that would have looked like this: gap fill reversal from the earnings cycle, then make a rotation back up to the equal high. Today's close extremely weak underneath the daily 50 SMA would sort of threaten, in my eyes, the equal low being on the table at 288.75. So looking for downside continuation out of Meta as long as we remain underneath the gap close area, which is at 301 even. Here's the hourly time frame chart. So even on a counter trend rally, lower highs that are set underneath 301, looking for shorts there, and then 288.75 on the daily time frame. Bulls only have something going on for an hourly inverted head and shoulders over the neckline, which could potentially, in theory, that's sort of a redundancy, potentially in theory, be there at 306.25. Moving along, next up is NVIDIA. What's going on with NVIDIA? Earnings are rapidly approaching next Thursday, almost a week out here. I think that this is in a tough location. Reason being is that you have all of this thin structure from the major squeeze on Monday's session. If we continue to drift into that, lose the daily 50 SMA again, this key structure is easily in sights in my eyes at 421.75. I think you have a lot of people who are likely disappointed, thinking that NVIDIA is just going to continue to drift off to the moon. So if we start breaking down into that Monday range more aggressively, I think you do see that deeper retracement where longs just start to panic out. It's like, oh, look, buying frenzy. It's short-lived, right? You just don't have enough structure that was built out where you can say, oh, yes, we have firm support here. This is the pullback by so on and so forth. This is much more so a threat for downside with people who chased on the Tuesday session who will get stopped out of their longs as we start spending more time really underneath the daily 50 SMA. Once again, 421.75 becomes the target. If it is going to materialize as a daily bull flag, Broad market's got to be participating, and it's got to be a pre-earnings run-up on a, continuation of momentum basically over 454. Once again, today's session doesn't really give me a warm and fuzzy feeling about new money longs being content lower high into the afternoon. Next up, Microsoft. What's going on with Softy? Balance range. This one is setting up just like we had Netflix set up, just like we had Microsoft, or excuse me, we are looking at Microsoft, just like we had Meta set up. This is setting up for the next rotation in my eyes. We have a balance range. Our job is quite simple. This or this. Broad market participation would be ideal. Flushing the 319.75 because Microsoft is such a heavy-weighted component of the Nasdaq 100 and S&P 500. I would imagine that, even if the broad market is neutral, breaking this probably puts downward pressure severely on the S&P and the QQQ, causing the broad market to more so accelerate the move out of Microsoft in the downward direction, right? So 319.75, if it breaks down, next key structure on the daily comes from 313.50. Here it is on the daily time frame chart to show you that structure. It's the pullback before the gap and go, which led to the last leg up of the overall trend sequence. 313.50. Buyers only have something going on with a confirmed higher low over 324. Last but certainly not least is Amazon, the mini beast. And what do we see here? This is what we need out of Google, right? If Google is going to be a short, it needs to be a lower high and trend sequence in the downward direction into the gap, right? So Amazon had the same concept. There's your price acceptance above. We drifted into the gap, but here's the confirmation, right? If you look at the hourly time frame chart, here's where we open, lower high stuffs into it, and then, where's the open? Yeah, that was the open. I was right. We stuff into it, lower high again into the afternoon. So we have an established hourly downtrend in the gap. We're not just coming from a pre-established existing hourly downtrend. So looking for the drift to continue lower, 133.60 becomes a target. Full gap close, daily 50 SMA 131 starts to become interesting underneath 133.60. If we do get back above 137, broad market participation wants to be there if you are going to look for a counter trend move, or at least it would be broad market counter trend Amazon in the direction of the trend overall. Just flipping back to the daily, noting that, okay, mild pullback, still certainly an aggressive daily higher low, something that does this on the hourly higher low there. Probably look for the rotation up towards 140.50. Two additional trade ideas, and then you are on your way. First up is Coca-Cola, ticker symbol KO. Now, the range here is certainly not all that attractive, but the setup definitely is. We have an inside bar inverted hammer after the breakdown of the bear flag range. The upper wicks continue to reject that level, which is 60.75. If we can get the equal low flush on the bar-to-bar count under 60.45, the target becomes 60 on the daily time frame chart. Even hourly time frame chart makes this quite clear. That's kind of what we'll be looking for as a target. And here is the continuous rejection in today's upper wick of the bottom end of the flag range. So once again, the range is not all that attractive to be trading for. The shares are easy to borrow in Thinkorswim, so if you'd prefer not to go in the options chain and load up with maybe illiquid puts, you could probably just short the shares and be fine that way here. Next up is going to be J&J. What's going on with Johnson & Johnson? The daily time frame chart is incredibly concerning. I mean, look at the volume ramping up here, obviously. There are some catalysts with everything going on in the healthcare space, we'll say loosely, as of right now, but just look at the upper wicks and the lack of confidence towards the top of this move. If this is going to set up as a double top, obviously we know that we have to be patient through the neckline, but to get to the neckline, if we flush the lows of this balance range, that could certainly get interesting. So let's go on down to the hourly time frame chart and pick off our flush point here at 172 roughly. I'd just round down. 172 is your number. This is thin structure to be retracing. First target is back down to the base of the strong rally from back here at 169.50, I'd call it. And that's a decent move here out of J&J. The options chain can certainly withstand taking some puts into that area. So J&J downside and also Coca-Cola downside. We don't have anything that's counter trend, anything that's for upside this week. I would mainly be watching something like an Amazon reversal or even just Google remaining in the range, right? So that's going to conclude today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a simple thumbs up. I hope to see you all tomorrow morning live, 8:15 for the pre-market prep. And with that said, I wish you a green trading week.